Hello and welcome to Property Question Time. This is your show where you can put our property experts to task answering your property related questions. I'm Stephen Galpin and joining me today are Kirsty Darkins, commercial property investor and mentor. Welcome.
Thank you.
And James Hadley, founder of Property from Pensions, pension tax specialist. Welcome to you.
Greetings, Stephen.
Good. Hope you both had a safe journey in. And so, Kirsty, we'll start with you. Do the panel think that the possible recession we are either in or heading for will cause a collapse in the commercial property values, particularly in the retail sector?
I don't think it will, because what accelerated decline in property values for retail was COVID, and they've already been rebased. So if you look at shopping centres, for example, shopping centres went into free fall just as they did in 2008-9 during COVID, because there was very little transactions, there was very little comparable evidence, there's lots of uncertainty in the market. And so the valuers at that point had to represent what was the real risk in the market. And so I think a lot of shopping centre assets, a lot of the prime retail has already been rebased. And so whilst we are now in or going into a recessionary environment, COVID already did what it would have done.
Right.
As it happened in 2008-9. So there's not a lot of movement required, because market rents have been rebased over the last few years, particularly in retail. You've had the business rates value revaluation, which is showing you the trends in the market, which valuers are also using in their assessments of current value. So I don't think it will have a huge impact across the board.
A lot of people cite the business rate, don't they, as causing a lot of the trouble in the retail sector, especially when you look at some of the big shops on Oxford Street, for instance. They're paying millions, aren't they, in business rate? And of course, at one time, before everybody got wise to it, it was actually bringing down the residential council tax in Westminster so much that Westminster, although so prosperous, was actually the cheapest borough of London to have your home in, because it was just, you were paying nothing in council tax. But yeah. I don't know.
I think the issue with business rates is that we don't tax the online retailers the way that the retailers with physical stores are taxed, and that's the bigger problem now. Is
massive disadvantage as well, isn't it?
It is a big disadvantage.
But hold on a sec. I kind of get that argument, but the other side to it is that the online retailers have still got warehouse premises on which they pay business rate, and they don't get anything like the service they would need or require if they were in a high street situation. So doesn't that balance it out?
Well, no, because most of the high street retailers also need warehouse premises, and not to the extent of some of the online retailers. But I think, look, it's been rebased. Most of the business rates for retail in particular will be going down significantly. The industrial business rates are going up, as they should, because that market's very, very strong. So it kind of rebalances between the sectors. But
so what's causing, say, Amazon, for instance, in they're shutting 2, 3, 4 of their critical sites, aren't they? Their distribution centres. So why is that? Is it because they anticipate higher rates, or?
Some of it will be watching their cost base, because the rents have gone up significantly in the last few years. The rates are also doubling, trebling in a lot of locations. So it'll be partly that, but also Amazon have become so efficient with technology that I think they're just in a position to rationalise their portfolio because of their innovation in terms of their operation and their efficiency.
It really is innovative, isn't it?
So are you saying almost that the sites that they needed before, but they're now so much more developed in their supply chain that they're surplus to requirements?
Yeah.
That's amazing, because you think about those properties maybe 5-10 years ago when they were being taken on, the owner of those probably thought, this is a really safe bet. We've got Amazon, we've got a 25-year lease, that's brilliant. And then now they're handing them back.
Well, yeah, because the technology in logistics is moving at pace all of the time.
Sure.
And it's having to move with consumer demand. And so, what the space they needed and they required at one point is no longer the same space that they need and they require now.
And that kind of sophisticated operation, they're even creating their own energy, aren't they?
Yeah.
Electricity and stuff. It's quite phenomenal, quite a change, isn't it? I think probably though, I think the normal retailers on the high street are just going to have to grow up and accept it, aren't they?
Well, they are. You have to build it into your business model, you know, but also you have to right size the space, and it's about use of space. So a lot of the high street businesses could do well to follow Amazon in rationalising their use of space, and like how much space do they actually need, rather than having more space than they need, and giving back upper parts, for example. So a lot of high street tenants take the whole building. They don't use it.
I can remember 20 years ago having an Amazon account and everybody said, well, what do you got that for? It'll never work.
Well, you see, as a commercial property investor, I try not to use Amazon wherever possible because I'm not helping myself. And I want to regenerate the high street. And so, you know, there are certain things Amazon's good for, but there are certain things that I like to go out and shop. So if I'm saying that to people, I can't then be hypocritical and order everything from Amazon. So I try not to.
And that was a question that I'd had for you actually, that in terms of all this rebasing of the value, how much of that is based upon the perception of repurposing the empty retail space? I mean, what are you seeing as real innovations in that area?
So it's changing the percentage of space that's used for retail, and a lot of it's being given up. There's a lot more leisure, so there's a lot more restaurants and leisure use happening. There is a lot of upper floor space being repurposed to residential, which is a good thing because it makes the location sustainable on a 24-hour basis. But there's also a lot of professional businesses using it as office space. So what was once retail space is becoming office, but ground floor office space, training centres, that kind of space, because it's affordable, it's accessible, it's visible space. And that was the planning use changes that came in 2021 that enabled that change. There's also a lot of healthcare providers now using former retail space for the same reasons, that it's accessible for their staff, their customers.
However, Kirsty, just to finish that one, it's quite perverse, isn't it, that Amazon are now opening a lot of these checkout free shops.
Yeah, absolutely. Yeah.
But that's life, I suppose. Okay, thank you. James, I see advertised what are called REIT investment opportunities for a property-related pension. Can the panel please explain how these work?
Okay. Well, a real estate investment trust, even the term itself can be quite confusing because it's not a trust at all. It's just a company. It's a UK company. But because it fulfills certain conditions, it's exempt from paying corporation tax. So they're quite attractive to certain types of, especially exempt investors like pension schemes, because there's no tax leakage. You've got the real estate investment trust itself that buys and rents the property. It's exempt from paying corporation tax on the rental profits, and then it can pay the dividends to a tax exempt investor without there being any loss of tax. Investing in them, I guess there's two ways of looking at it. You've either got the market itself, where you can go along and there's FTSE 100 REITs, tens of billions in some cases under management, all the way down to what are ostensibly private REITs that are set up by maybe small family offices or ambitious fundraisers. And while they fall into the REIT regime in terms of, from a tax perspective, if an investor were to try and get into that arena, you've got a problem with getting out of the investment sometimes because there's not necessarily the same liquidity that there would be of a large FTSE 100 stock.
Right. Well, that's like trying to sell shares in a non-quoted company, isn't it?
It's pretty much the same scenario. So really, you're at the mercy of your broker because it's a matched bargain. If you haven't got someone to buy, you can't sell.
Yeah. Okay, got it. So, if you wanted to get into one of these REITs, presumably one of the bigger ones, how would you do that? Who would you do it through?
Well, I mean, traditionally, I guess it would have been your stockbroker, wouldn't it? You'd go and set up an account with a large brokerage, and you'd instruct them to buy or sell. These days, there's a lot of online platforms that are low cost, all seem to be competing on price, where people can go and transact their own share purchases. And
would there be a minimum sort of investment figure?
Oh no, I mean, we can't name any of these platforms, but some of them you can set up with 50 quid, 100 quid. I don't really know how they make any money, but that's their business model and not mine.
That's an interesting way of investing, isn't it? What would you got to say about it?
It is. I mean, I think, at my time at some of the bigger property consultancies, a lot of our clients were REITs, and they do take, they obviously take a lot of professional advice, and it was interesting to watch what they're doing. And again, it's a good way of learning about something, being able to invest at a low level in a REIT, see how well it does.
But see professionals do it.
Professionals do it,
yeah.
Exactly. So I think, it's there as a model. It's in setting your own up, it's kind of the preserve of the wealthy.
Well, yeah,
really.
it has been historically, but if you look at the history of REITs in the UK, I mean, we're really slow on the uptake. The US bought them in 1960. Ours was in the Finance Act 2006.
Yeah.
And I think initially there were probably about 15 large property companies that moved over to REIT status. There were frictional costs of doing so. But then the legislation was rewritten into Corporation Taxes Act 2010. And what that said, if you're looking back, if you looked at the Act 2010 back to 2006, you can see that the government made it a lot easier to enter the regime. The government wants to see more of these. But actually we had a big raft of changes that came in 1st of April last year, which now make it even cheaper to set up a REIT.
Okay. But just very quickly, I don't have too much time left in this half of the show, but what's the government's driver for giving consent to these schemes? What's in it for the government?
Well, I guess it depends on which sector they're focusing on. I mean, social housing REITs have been in the news a lot recently because there was one particular that didn't start trading on the stock exchange first day back in January due to some inadequacies. But if you look at that specific sector, driving hundreds of millions or billions into social housing is solving a problem and a headache that government have had for years. I mean, I'm told, I'm no expert, but there's over 1 million people on housing waiting lists in the UK.
So social housing is considered commercial, really, then?
Well, it is in a way. The way the leases work are commercial,
because
of course you've got the owner and they're leasing them. So the REIT is the owner and they're leasing them to providers.
Right. Okay.
But they're dwellings in nature.
Yeah. Okay. But the REIT wouldn't be involved in the end use of that property.
I hope not.
Only in the provision to the provider.
Yeah, absolutely.
Yeah, got you. Okay. All right. Well, that's all we've got time for in this half of the show. So join me again after the break when we'll be asking Kirsty and James more of your questions. Hello and welcome back to part 2 of Property Question Time. I'm Stephen Galpin and I'm with Kirsty Darkins and James Hadley. So, Kirsty, your second question. I see on the internet many tutorial opportunities to learn about residential property investment. However, very little concerning the commercial investment opportunities. Is this because it's ideally only for experienced investors, or is it that the level of investment is so much higher and more complex than residential?
It's an interesting question, Stephen. Yeah, it is an interesting question. I get asked this question a lot, and partly I think it's because there's the lack of familiarity with commercial over residential, because everyone lives in a house and everyone feels a level of comfort with residential. And residential investment is easier to get into. The lending's easier. You can start with a very simple buy-to-let. There's perhaps a bit more to learn in commercial. And so I think it's easier for people who haven't got a professional background or haven't been doing it for years to provide tutorials and to help other people. So you only need to have been doing it for a few years and then people seem comfortable to be teaching other people. Whereas in commercial, it tends to be on a more professional scale. And so there are less people advising. It can be more complex.
I was going to say, I mean, it would be quite normal, wouldn't it, for somebody who's interested in going into residential buy-to-let to sort of walk into the local agency and sort of say, can you guide me? Can you show me what you've got, what you haven't got? Do you think a commercial agent gets those kind of inquiries that much? Or?
No, I think it's a much more professional market. And I think people's perception is they can't do that. That's not necessarily true, but the perception is that they can't do it. Well, they have to know what they want to start with. So they have to start finding out about commercial, you know. So, well, the number of investors that I work with that surprised me, I had a call yesterday, for example, with a lady who wanted to start investing in commercial, but she didn't know why, where, what returns she wanted, what price bracket she wanted to start investing in. So she didn't understand what her end goal of investing was. And therefore, as a commercial property professional, I can't help you at that point because I don't know what you're trying to achieve. And commercial market's as broad as the residential market. But I do think you do need a bit more to start investing, because you need a bigger deposit. And also, if you want to be able to add value and recycle your capital, you need a bigger amount of capital to start investing. So yes, I do think that's an element of why there are less people.
I think the other thing is with commercial, although voids are something you take into account with buy to let, and you calculate a figure in at whatever your local people advise is the norm. But with commercial, although the turnover of tenants will be less, and therefore the void potential less in that scenario, probably you're going to have longer to wait till you find your right tenant, I guess.
Yeah, I guess, and again, but that's about actively managing your investment. So you should be taking rent deposits from tenants if they're not PLCs, which gives you 3 months grace if something should happen to that tenant's businesses. You should be in touch with your tenants and have a relationship with them, which means you're checking in with them on a
But I was thinking,
basis,
from the moment of you buying that commercial property, if it hasn't got a tenant, it's probably a bit more of a job to find a good tenant rather than in buy-to-let, isn't it?
It's an interesting point you raised there, though, Stephen, because is it true that typically you'd get the property a lot cheaper with no tenant anyway?
Yes.
Okay. So is that where you'd actually get
I suppose that's where the balance comes, isn't it?
Yeah, so there's no
but you've got to be ready for it.
There's no bricks and mortar value to commercial property. It's all in your income stream. So if there is no income stream, it's only worth what you're willing to pay for it. But I think there is a general perception that, it takes longer to let commercial property, but it doesn't if you buy it in the right location and you're serving the demand that's there. So if it's the right size, it's in the right location, it's in the right condition, you will find tenants.
Any tips on right location?
Right location. So, you've got to serve the demand. So the right location is talk to the local commercial agents, ask them what is their demand for in this location, but also look around and make sure there isn't a high level of vacancy. So if it's high street, for example, the shops aren't all empty, because if they are, that's definitely not going to be the right location. So you're looking for the right tenant mix, and serve the demand with the right size property. So there isn't the demand for the big units that there used to be in our high street.
Quite interesting. I was talking to one of the guys at Canary Wharf here, and Canary Wharf has really, from almost day one, been very successful on the retail letting. And I said, why is that? Why haven't you suffered along with other people in this industry? And he said, well, actually, he said, I was criticised at the time. He said, but I took a different view. What I did, I looked at the demographics of the of the workers in Canary Wharf and what they were likely to want. And instead of just going out trying to find the highest paying renter and the biggest name, I actually made it bespoke to the people that wanted to work here and therefore wanted to buy things here. And he said it served us really well, and I thought that was quite a...
Yeah, and that's definitely the way, is asset manage your tenant mix. We do that in shopping centres, but for me now, in my own investment portfolio, a lot of which is high street, I am always interrogating what do local people want, what's working, which businesses are looking for space and why, and how sustainable are they. So, you need to really look into the sustainability of the businesses.
I mean, as a good commercial landlord, you've got to have as much confidence in the business going in as the tenant has, haven't you, really?
Yeah, absolutely. So you need to do that level of due diligence, So I've got a tenant coming in this month. I asked them for their business plan. I looked at their last company accounts. I've sat and talked to them about their business proposals, because it's that important.
Okay. James, another pension question for you, which is seeking, I suppose, comfort. Would the expert think that a property-related pension plan is riskier than an investment made up of normal stocks and shares? Are there, for example, any comparative charts mapping performance? And if so, where would I find them?
Well, I guess we're back to the first principles of defining risk. What's risky to someone else might not be risky in another circumstance. And I mean, look, there's a massive amount there's an overwhelming amount of data out there that if you just look for it. But it's how you interrogate it that's the issue. Because you can get all sorts of comparative tools that can make things look good or bad over the short, medium and long term. But I think it's going back to how you perceive risk, really. Because with with property in particular, you've got two types of risk that are particularly inherent to that asset class, and you've got liquidity risk. It's quite easy to get into it, but it's not always easy to realise money to get out of it. But then you've also got concentration risk, because they're big lumpy assets. It's not like you can just sort of say have £1,000 of that share and £1,000 of another and split that over 100 different positions in a portfolio. You might have 2, 3, 4, 5 if you're lucky. And I think those are the sorts of risks that are, I mean, I don't know what you think, but those are the sorts of risks that are on my mind about property if I'm being balanced on it.
I suppose you're right. You've got to be careful with this data, haven't you? I mean, if you looked at, you look on some of the traders for Bitcoin at the moment. Well, if you have a look this week, I mean, it's just like that, and you think, wow, this is amazing. Yeah. However, if you stretch it out to a 12-month period, it doesn't look so clever at all, does it?
No. I think you also don't have to spread yourself too thin, because you need to be informed to invest in anything, whether it be property or shares or Bitcoin. And I feel there are too many people, or I see a lot of people who I think you're trying to do too many things, so become informed and an expert, or get the advice in one or two investments, and then decide what your level of risk is and your appetite for risk, because it depends on your stage of life a lot of the time, I think, as well. So, with my clients, their appetite for risk is different depending on what their current life circumstance is. And, is this their retirement pot, and therefore that they're slightly more risk averse, or are they at a different stage in life and they're investing for capital growth and they're willing to take higher risks to drive that capital growth?
And again, it's what level or percentage of their available capital is going into something, I guess. I mean, that's a huge balancing factor.
Yeah, I mean, it definitely shouldn't be 100%. It's like,
no, and I think one of the things you said just about education, and I think that's a really good point, is that anyone going into anything should be informed. They should be educated. They should do their research. But actually, there are only so many things that you can learn to the requisite level to be expert enough in them. And I think sometimes there is, probably in a lot of the communities that we inhabit, there's a lot of people who think education is the answer to everything. Yeah. And so they naturally end up learning just 2 or 3 things, which in reality is very small in the investment universe. They end up overly concentrated in it. And whereas they could perhaps get more of that diversification if they sought a range of advisors rather than just a bunch of educators.
Yeah, exactly. And I think that's the point. If you even look within property at residential and commercial, the percentage of investors who invest in commercial is very low in the private investor community. And actually, you should have a diversified portfolio, whether that's diversifying by sector or whether it's diversifying by market. And a lot of people do invest too heavily in one particular sector. Yeah. Then when economic, political changes or things that we didn't see coming happen, you can get surprised in the wrong way.
Sure. And I guess that's where syndicating some property investments can help, because rather than buying 1 unit or 2 units, because that's your budget, if you'd syndicated with a bunch of 10, 20 other investors, and you can take multiple positions with different tenant profiles, different assets, different income profiles, leverage, non-leverage, you can always create that portfolio through the syndicates.
Yeah. Okay. All right. Well, just for the last 20 seconds each, you're both involved in the property market one way or another. So are we in for a bumpy ride the next couple of years?
We are in for a bumpy ride, and you need to do your due diligence and make your decisions accordingly. But it's been bumpy for the last 2 years, so more of the same.
Well done. Yeah, I think we're absolutely in for a bumpy ride, but I can't remember the exact quote. I wouldn't. But calm seas don't make strong sailors. And I think that whether markets are going up, down or sideways, there's opportunities if you're prepared to take them.
I think you're absolutely right. Okay, well, Kirsty Darkins, James Hadley, thank you both very much for coming in. Great show, great answers. Thank you very much for your information and advice. I'm Stephen Galpin. That's all we have time for today. So join me again next time on Property Question Time.